Let's take you here now. Investors around the world have been on high alert since last week Thursday, when Russia, the world's third largest producer of oil and gas, invaded Ukraine, unsettling global markets. A global crisis and associated market volatility can result in anxiety and panic. But investors are cautioned against hastily reacting to any declines and locking in losses by selling out of their investments. Now, joining us is Kelin Pottier, Product Development Specialist at 10X. He joins us now. Kelin, thank you so much for your time this afternoon, and good afternoon.
Good afternoon, Lati.
Of course, we don't meet in very good circumstances. What is the impact of this ongoing conflict between Russia and Ukraine on investors? I mean, Russia alone is of particular importance to the global economy as the world's third largest producer of oil and gas, as I said in my intro.
Absolutely. Firstly, we acknowledge the deep humanitarian crisis of the conflict, but this is also affecting global markets. As we've seen, oil prices are surging as investors speculate on further supply shortages to come, as Russia is effectively removed from the global supply of oil. OPEC has stepped up to some degree, but really this is starting to drive inflation expectations, which particularly impacts emerging markets like South Africa, who are already experiencing the impacts of higher fuel prices at the pump.
Now, as 10X, you are cautioning investors against, hastily reacting to any declines and locking in losses by selling out their investments. What is currently happening now, and what can those who have investments do to protect their returns?
Fortunately, South Africa has actually been a net beneficiary of the Russia-Ukraine conflict. South Africa is actually the world's largest producer of platinum group metals and has actually picked up on the lack of supply from Russia. So the spike we've seen in platinum group metal prices, gold, as well as the depreciation of the rand against the dollar has really benefited the heavyweights on our local market, resulting in the JSE actually being up in all sessions since the conflict started. We encourage investors to remain committed to a long-term investment strategy, to diversify their portfolio, to minimize the negative impacts of undue risk, and last but not least, to maintain an investment allocation that is consistent with their risk profile and their investment time horizon, of course.
Now, just going back to what you said in terms of a net beneficiary, so what then would be your advice to those who are willing to invest? Which sectors can they then start looking into?
So we've seen broadly the South African equity market benefit, and that really has come through from the heavyweight resource companies. So we've really seen the likes of BHP Group, Harmony Gold, our platinum miners such as Impala Platinum, Anglo Plats really benefit, as well as indirectly Sasol from the rise in the oil price. So it really is our resource shares that are lifting the local stock exchange, as well as the rand hedge counters, which are benefiting from the depreciation of the rand. However, the rand has held its own against relative to other emerging markets, and we do believe that investors who are withdrawing from Russia following sanctions are actually finding very attractive value in the local market, and we expect to see some of that money enter into SA shares.
Now, in one of your statements, you say, in response to rising risks and tensions, global markets turned risk off in the week ending 28 February 2022. What do you mean by that?
So during times of risk-off sentiment, investors typically, given the uncertainty that exists in the environment, tend to reduce their risk exposure, which typically means reducing their investments in equities as well as emerging markets, of which South Africa is one. Investors in risk-off sentiment times would then invest in hard currencies or safe haven assets such as the dollar, US bonds, as well as gold, to protect their capital from loss until uncertainty subsides and investors find opportunities to start deploying that capital again. So we initially did see markets turn risk off in the wake of the conflict. However, there has been a subsequent relief rally, particularly in developed markets, as investors have actually started to look at the impact that the surging inflation and the crisis would have on future expected interest rate hikes from global central banks, which now seems to be that the market is expecting less interest rates hike than was expected prior to the conflict initiating.
Now, Kelin, as we wrap up this interview and just going back into the Russia and Ukraine crisis, particularly how the West reacted, to the invasion, and the US and its allies ramped up their sanctions on Russia, and particularly shut off many of the Russian banks from the SWIFT global financial payment system. What does this all mean, particularly banning, what does this ban mean particularly to those who have strong ties with Russia?
This really does cripple the Russian economy. Firstly, Russia itself is not able to access its foreign reserves sitting within the accounts of central banks, particularly in the US, the EU, and allies of the West, which limits Russia's ability to fund conflict further. It also prevents Russian oligarchs as well as Russian companies from being able to transact, whether it is to import key materials or export, as effectively those wanting to do business with Russia can't transact with their banking system. And it really brings the Russian economy, and particularly the financial system, to a standstill. In reaction, we have seen the Russian economy try to arrest the depreciation of their local currency, the ruble, by hiking interest rates, in fact, more than doubling interest rates to about 20%.
Okay. Kelin, thank you so much for your time this afternoon. Really do appreciate it. Kelin Pottier, Product Development.